The entire financial system is being reconfigured as I speak. If you look at this data, you're going to be amazed when we start to connect the dots. Taken as individual pieces, it's not a big deal. But when you start putting it all together, wow. My name is David Quintieri, and I have been looking into all this financial wizardry for well over 10 years, and I have been dissecting this and bringing these videos to you. I try to make it easy, I try to make it simple, so that we can actually grasp what all this nonsense and jargon and all that which these academics create in their own minds and try to explain that and actually further complicate things. Take all that, make it real simple, real easy. Let's start with what's happening with the bank crisis. Then I want to talk about what the G7 is doing and all of this connected in together and what it means for you and the economy that you've got to deal with. Let's begin. You came here for the truth, so let me unveil that for you. US bank deposits fall for a third week. That is $26 billion dollars again. This is just continuing on and on, but we've been told so many times before that everything's fine. I mean, really, how many times have we heard the bank is safe, your deposits are safe, there's no concern with the financial system, look at the jobs numbers, look at all these different stats, and they tell us everything is fine. But is it? Why are people pulling out literally billions upon billions of dollars? There's a concern somewhere. Okay, and then we look at the next part of that, which is bond traders are losing their faith in the Federal Reserve, that they are done tightening monetary policy and will ride to the rescue with rate cuts this year. So interesting. You got to ask yourself this question. Why would the bond market believe that the Federal Reserve is going to cut interest rates when they are at a level which is sufficient, what they call sufficient, to stop inflation, to make it get worse? This is it. This is the level. Sufficiently restrictive. And at the same time, you look at the jobs numbers, unemployment, like all of their stats. Unemployment, even inflation to some degree, just name it. Just name the stat. The stock market, okay. It's really not bad when you look at their data. Not the data that you and I know about, but the data. And so why would they cut rates? Just because the bond market's acting up? I mean, that really, there is no justification for that. They have to come up with another excuse. But the bond market is definitely pointing in this one direction, that in 2023, there will be rate cuts. And there will be 75 basis points or 0.75% of rate cuts in 2023. So unusual. How does this make sense? Can you make any sense of this? Why the bond market is pricing that in? I know that you've said in the comments, I've read those comments, and please keep them coming. Why is the bond market pricing it in? Is it simply hoping and praying, or do they know something that we don't? The latest shift in sentiment, which during the past week put the odds of a quarter-point rate hike next month as high as 40%, will face a test in the coming week from a slew of data that will gauge the strength of the economy. So just recently they were saying, yeah, we're going to have another hike, and things are changing. Things are really changing, in fact. Look at this. The latest marker of underlying US price pressures will offer little hope of settling the debate among the Fed officials about whether they've made enough progress on inflation to step off the monetary policy brakes, because they saw their favorite inflation gauge, the PCE, a personal consumption expenditure. But the best part about it, I'll always love to mention this, personal consumption expenditure. You would think it's like, the stuff that you buy, right? Oh yeah, but that's excluding food and fuel. Does that make any sense to you? Oh yeah, just those like really, really important things. Yeah, we're gonna exclude that. Anyway, so it's ridiculous. So that has actually remained elevated. Now, even though that's a manipulated stat in that way, despite that, it is still elevated. That means they don't have an excuse to actually cut interest rates. Do you get what I'm saying here? Do you see this? Bank crisis on one hand, they're telling us the banks are safe. They're looking at different indications, the Treasury, FDIC, the Federal Reserve, they've all done what they've had to do to make sure that the system seems safe. The bond market is saying we need rate cuts this year. And then deposits are doing one thing. I mean, it's like all over the place. Something fishy is going on. It's time to rethink the love for cash, with the Fed most likely done. Cash very rarely outperforms. That's according to JP Morgan. This is true, actually. Okay? And I think it's interesting just to see how they've been playing out during this period of time with these big investors and what they're doing. And they're saying that, we're going to hold on to a lot of cash, we're unsure and so on. But there's a true fact is that inflation eats away at your savings. And so you don't want to keep much in cash because you're going to lose over time. And that's why I always tell people real assets, and real assets. Okay, very important stuff. And business, by the way, I'm just going to throw it in there. Business is a real asset. Business. Okay? And so we have to look at what's happening with the G7 and inflation and all of that. And I want to touch on this first. Britons suffer larger price rises for the basics than EU shoppers. Look around you and you will see the prices are just unbelievable. Shortages of different things. I mean, Europe's in a mess today, and that is certainly going on, not just in Britain, but all over, it seems. Affordable housing is just talking about the decline of affordable housing. You could see this infographic if you want. Everything is sourced in the description as always. But as we see here, housing affordability has continued to erode in the US since the mid-1980s. Isn't it so funny that that was the time in which they started to reduce interest rates? How weird is that? Isn't it? Isn't that so funny? Reducing interest rates is supposed to make people able to, I can borrow more, it's easier, it's better, it's fine, right? But that's not the case because the prices go so high, the rents go so high, all the prices that I have to pay at the store become so high, but my wage doesn't keep up. And that's a matter of fact. Do you see how all of these things are connected together all around the policies of the central bankers? They are the ones that drive everything. Now, I want to talk to you about this. ExxonMobil, they've been talking about this. And of course, these type of industries, they're always saying they're polluters. They've got to get to net neutral by 2050. This is from they're going to make references in this thing, IEA, okay? From the IEA, the energy agency is basically just pulling out this thing of being net neutral and all that. So Exxon does this report, and they mention something that I think is really, really key, because it shows us that what they're doing with all this ESG, and they're trying to tell us that you got to eat the bugs for the environment and all these things. But look at what ExxonMobil has to say. Okay, it is clear that the IEA NZE, that's the net zero emissions, does not, by the scenario author's own assessment, meet the level of likelihood required to be considered in our financial statements. Likewise, it is highly unlikely that society would, this is huge, okay, look at this, that society would accept the degradation in global standard of living required to permanently achieve a scenario like the IEA NZE. A permanent degradation in living standards. What they're saying is, you get rid of all these things to get to that net zero, you are going to lower the standard of living, not for the billionaires, not for the 100 millionaires. It's for everybody else. You squash them down. That's the intention. That's what's happening here, and that's what this is all about. Because there's going to be carbon taxes, there's going to be this tax and that tax, and there's going to be essentially an allotment of carbon that you have. And so you can buy your way out of that. You can simply get a waiver if you're a big corporation that needs to pollute. You're going to get that pass. But at the same time, you, the middle class, you got to get to work. Can't do that. Or maybe you just want to go out and get in the car and go for a drive with your family. Can't do that. These restrictions are putting in place, and this is all around what happens with the central banks, and of course, the way that the monetary system is all interconnected. And this is not one country over another, though some countries have, more strict rules and things. These are decided from the higher up, G7 and so on. Lots of stuff in here that, quite frankly, I don't have time to get into, but this is just talking about the G7, and they're reiterating their aim to pull together up to $600 billion in financing for their global infrastructure development initiative, meant to offer countries an alternative to China's investment dollars. So they're saying, no, don't go to China. We want to deal with this. Anyway, the point here is that all these countries are basically on the same page, and I think it is imperative that we understand this and that we go through and start learning how do we get around this and what can we do as individuals. I talk about the pillars of prosperity all the time, but I also have a playlist called How to and Solutions that I think you should be aware of. I'm going to get more into depth with helping people one-on-one and in group classes soon. Stay tuned for that. I'll see you tomorrow. Hit that thumbs up, all right? It's very important that you do so that it notifies the algorithm. And I'll see you tomorrow. Take care.